Today's episode of Market Talk is brought to you by GrowMark FS. Keeping up on the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic grain and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. And good afternoon. Welcome into Market Talk for this Wednesday, July 7th. I'm your host, Jesse Allen. Great to have you here with us as always. MarketTalkAg.com. That is our home on the World Wide Web. You can find all of our streaming sources there, find all of our radio affiliates, our social media. Everything is linked up at MarketTalkAg.com. That is our home on the web. We got a very interesting day in the market trade. We're watching a lot of factors here throughout this market environment, and always happy to have on our good friend Mike Zuzolo with Global Commodity Analytics here on this Wednesday. Let's bring in Mike, and good afternoon to you, sir. And coming out of the holiday weekend, the weather forecast changed. We watched a huge sell-off, huge down day on Tuesday, and then we come in Wednesday, fairly mixed day, and really just it's an interesting dynamic of this market trade. It's surprising how much that change in the weather forecast really influenced us here the last 48 hours or so, Mike.
Yeah, and this is a dynamic that this week is probably the most crucial week for the price trends. And because I don't think we really know for sure, Jesse, whether the weather is the ultimate culprit for the post-July 4th sell-off. I think we can see by the volume and where the biggest percentage declines are that the major fund liquidation pressure is led by the corn market. Corn is going to be the key here, not just from a standpoint of the investor mindset and the technicals, but also from a standpoint that the country is pretty much shooting tassels at this stage of the game. And I guess I would say to you that as we started this week out, it looked like to me that this was program funds more than it was weather. Why do I say that? Because the spring wheat was one of the leaders to the downside along with the corn. And we've actually seen countries like South Korea and some other countries come in and buy wheat, buy feed wheat, and get needs covered in the wheat sector. So that kind of gives us an idea that the wheat market is low enough already to be attracting the demand side of the equation, especially demand away from corn for the livestock feeders globally. And I would suspect domestically that's still being ramped up too. So between the spring wheat and the buying of wheat by major importers, it really makes me wonder whether there's something else that's not out there looming that we maybe don't know about, whether it's a policy issue or whether it's the strafe that we're getting into between the United States and China. These are all issues you just don't know. And that's where you kind of set a marker down, and those lows from the middle of June that you and I talked about, that 629 area, 629 and a half area in the July corn, that's still the number one feature to me as to whether this market needs to be hedged or whether we can wait and try and fill the gaps, which are now above the September and the December corn charts.
Mike, let's focus specifically in on these commodities. Let's talk corn first. Let's stay on that trend. And I know you sent me some charts to look at here on the video, and this is looking at December corn, the continuation. Why don't you run us through this a little bit and some of the things that you're seeing here in this corn market?
Yeah, my suspicion, and the lines on these charts are my value level lines. I did two sets this year, Jesse, one for drought and one for no drought. And the blue line at 530 is my estimate as of March 1, which I'm getting ready to update these value level numbers at the end of this week based upon USDA's acreage estimate, my acreage estimate, and then what kind of rainfall we see here heading into the next 10 days. But be that as it may, that 530 line in the sand essentially says that's what I think overvalue is in December corn if we can shake out a 1.4, almost 1.5, 1.5 billion bushel carryover. So that line has proved to be very useful because you notice in the last 4 months we have gone down and tested it, gone through it, tested it. We have never closed below it, though, in the last 4 months. And that, at the same time, has set up a really nice trend line literally, essentially, the last 12 months or roughly 12 months, we have tested a major trend line in orange that has not given way. And so that is a massive technical support level that I think would uncover probably immense numbers of sell stops and really kind of break the back of the bull market, in my opinion. So if I join these fundamentals and technicals up with that July corn and the lead month futures, and the fact that that spread between July futures and these futures still suggests the cash market is closer to $7 than it is to $5 where new crop cash corn is. This is kind of what I'm talking about. Is I'm not going to get in the way in the analysis of saying, oh, the market's wrong. It's going to come back. It doesn't really matter when lines like this are violated. You get your puts bought and you just sit back and see what happens going into the end of July.
Well, and Mike, we know as far as the other side of this, the other leg is world corn supplies. And I know we know the story in soybeans, that's really tight, but corn is something that I think we haven't touched on a whole lot, but that's tightening up as well. You think about that Brazil crop and everything else. And I know you got a world corn futures chart here. And I think this is interesting to look at this chart as well and see where everything is kind of stacking up worldwide.
Yeah, this is a really neat chart because it's a futures chart and it shows at the white solid line at the very top where China's prices are. That $435 a ton equates to about $11 a bushel, Jesse. And so we're talking about nearly $11 a bushel Chinese futures right now compared to almost half of that in the United States, and well under half of that in countries like Argentina. And I think this is where something is not making sense when it comes to Argentina being too low of a price right now, given their corn likelihood of not being a great crop. Brazil, it looks a little bit too cheap, even being below $300 a ton. But you can see that Brazil is pricing itself out of the world market already compared to the United States, which is in purple. And so between these two charts, we should know here, I think, relatively soon, what the world supply demand really is and the world stocks to use ratios really are, and whether these futures prices are correct, i.e. the WASDE report and that Brazilian crop. Is Agrural correct in taking the Brazilian corn production 11 million tons lower than USDA's last estimate of 98.5 million tons? I don't even think these kind of things are being looked at right now in the corn market this week, especially given that spring wheat, again, has been one of the leaders to the downside. And if you look at those crop conditions reports, other than the corn and the soybeans, which are the second lowest in the last 5 years, the barley, the sorghum is almost the best that we've had in the last 5 years, but the barley, the spring wheat, the oats, and the pasture and range, all of them are the worst condition we've had in the last 5 years. So I'm just simply saying something's got to give here, and it would not make any sense for the technicals to give up the key trend line in the December corn unless July's falling, and there must be something other than weather out there that's breaking the back of this market.
And I agree with you. I think there is something else out there that we're just not seeing. You know, of course, though, a lot of these funds and the computers, they're just going off the Twitter headlines. They're creating the weather, and that's
Right.
the big thing. But I agree with you. I think there's something else out there, not to get too speculative or anything, but it feels like there's something else out there brewing under this market. And, you know, of course, we don't want to discount the weather. The bullseye's on Iowa here this week. They're talking a lot of heavy rains. We've already seen some through that northwestern belt. They're talking more in the forecast Thursday and Friday. I mean, that could really go a long way to helping our corn crop and all of our crops in that northwestern corn belt, especially Iowa, southern Minnesota, which has really been under the gun of stress. And as you mentioned, this is that key time for pollination right now in corn, Mike.
Yeah, and this is where it goes back to the crop conditions being in the corn and the soybeans the second lowest in the last 5 years. That really puts the onerous on the USDA's yield number of 179.5 and 50.8. I mean, for soybeans, for instance, we're very near, I think, 2017, and that yield was around 49.3. That's essentially where I'm probably going to come in, is just under 50 bushels to the acre when I do my update at the end of this week based upon my yield model that I use. So if I combine the acreage base USDA gave us, which was lower than the trade was expecting, I expect that the soybean demand is going to stay relatively strong when it comes to China because they are rebuilding their hog herd. Their imports have not let up, especially from Brazil. You add all this together, and Jesse, it's going to be really, really difficult to get up to or above 150 million bushel carryover this coming year. So at some point in time, I think that the world stocks and the U.S. stocks are going to come back in and work this market. Having said that, look at what happened in the soybeans this week. $1 lower at times, almost hitting limit at times when we came back from the July 4th holiday. If there was ever a time where bought puts made sense to a client or a subscriber, it was that trade after we came back from the July 4th holiday. Having those in place, hoping they don't do any good at all because we're not selling cash bushels and we don't know what our yield is in the field right now. Those things are really, I think, very good property. And that's why these technical trend lines are so important, to get the hedge in place and not have to try and outthink this market. But I agree with you. I think there is an issue with yield and the updated model maps as we go through this week, and the actual rainfall totals that we're seeing right now. You're getting those 1-inch rains, but they're in a lot smaller area, and coverage is not nearly what the models were using or were expecting. And so the models are using a much broader paintbrush when it comes to the totals and how far covered out they are. And I think that's going to be an issue when we get into Saturday, Sunday of this weekend. So when we went limit down in corn on the post-weekend holiday trade this past weekend, it would not surprise me to do either the same on the next weekend on Sunday night's trade, or go limit up on Sunday night's trade. We've talked about this volatility. This volatility is for real. If you don't believe it, you should now. And so get the puts bought and sit back and wait.
And I fully agree with you. And, you mentioned a 1-inch rain. It's still not going to fix the entire problem. That's the thing, too. We need to keep it perspective. And, that brings me to an interesting question I wanted to pose to you. I've had a few farmers here in the last week or two bring this up to me, saying, hey, it's hard for us, us guys and gals to trade this market anymore with just all the funds out there and everything else. It's very stressful to try and compete against a lot of these big hedge funds and everything else and all these players and all this money that's flowing in these ag markets. But I know we talk a lot about being disciplined, getting those strategies in place, things of that nature. What would you say to some of those guys and gals out there who are getting more and more apprehensive about working and marketing in this ag trade due to all the volatility that's out there right now?
Yeah, I was talking to a new fellow in West Texas this week, and I've been talking to him several times over the last couple of weeks. And he and I were talking, and it really boils down to, and he really helped me kind of frame this question because it's a very timely question you're asking. He really helped me understand that you cannot, in my opinion, in my experience, you cannot pick tops and pick bottoms in the marketplace. You can assume or expect corn to go to $8 a bushel, but you have to lay out a plan in case you're wrong. And, that's one of the things that I first started. I had a manufacturing background. I have a political science history degree, but a manufacturing background to work my way through college. And I worked in the quality control department for quite some time. And I realized that what they really did in quality control, if it was going to be a good quality control department, was they always kept asking themselves, what if I'm wrong? What if we don't do a good job? How do we fix the problem before it becomes a big problem and it's a small problem and we don't lose a lot of money? And I think that's what I tried to instill into my analysis, is that I think I'm right in my analysis. I show the clients why I think the way I do. But then I also immediately say, what if I'm wrong? How do we backtrack and kind of help ourselves, give ourselves a back door in case I'm wrong? And I think that's where a lot of the producers that I work with did not want to buy a 30 or 40 cent bean put because it just looked so expensive. And it was, but we were talking about protecting $14, $13 beans, not $7 or $8 beans. So I think you got to look at it from that perspective, is you need to invest, in my opinion, in case you're wrong. And if you're right, then that's great. But if you're wrong, you've got a back door. And what I try to do, and this is not foolproof, but what I try to do, like in soybeans especially, if I buy a 40 cent put, I want to have a marketplace where if that 40 cent put doesn't make any money for the clients, then I think that we can make at least 80 or even maybe $1.20 on the upside. In other words, a 3-to-1 risk reward ratio is what I try and go after in the soybeans, a 2-to-1 risk reward ratio is what I try and go after in the corn. It doesn't work all the time. It doesn't work every time at all, but it's a goal. And I think that's the bottom line is you set your goals, you farm your plan, and then you sit back at times and don't let the emotions get to you.
Mike, let's switch over to livestock, talk about that briefly. Mostly lower trade on Wednesday. Cattle finding some resistance in that feeder market, it seems, around that 160 level. Just taking a glance here at Feedlot Country today, a little bit of activity. It's pretty much steady with last week. A few slightly higher bids out there, but nothing amazing. What are your thoughts on cattle? I know we saw a good update with the huge drop in grains on Tuesday, but where do you think this cattle market is headed right now as we come out of the 4th of July holiday and maybe we restock our coolers a little bit?
Yeah, this is a good time to really reflect on the cattle and the hedging, because I think the fat cattle in particular, Jesse, are trying to search out what a good price is for the cash market to finally get moving. There's a big story in the Wall Street Journal that hit after the 4th of July holiday talking about major grocery chains hoarding or buying extra sugar, meats in cold storage, basic goods, not wanting to get caught with a lower inventory, and they don't want to get caught with a price increase, especially. So they're buying extra while prices are cheaper, expecting prices to go up here in the next 1 to 2 months. I think that dampened down some of the trader enthusiasm about the demand side of the equation, the summer grilling season. In the fat cattle market in particular, we really need the hogs to stay strong, and we haven't seen that. We haven't seen that pork and bean trade remain in sync with one another. When the hogs go up, the funds usually buy the beans, and vice versa. And downside, the same thing. They usually have been running together these last few months. That's starting to break apart. So I think the fat cattle market is nervous right now, and it's trying to seek out a cash value. I'm hoping by the end of the week we can come in here at 125, 126, and kind of flatline this futures market and kind of breathe a sigh of relief that we're at a good price level and there's not too much premium in futures. Feeders, I think it's a little bit more simple. I've heard a lot of Northern Plains cattlemen, stocker guys, just essentially throwing in the towel and liquidating. I think we've got a lot of supply out there in the feeder market right now, and it's probably curbed the cash bids. And then the thing that the feeders are relying upon, like you said, is the corn price break to the downside. So feeders, given its premium to the fats, I think it's the most critical to hedge at this point. And I think we were talking about kind of the opposite a week or two ago, where I was really wanting to get the fat cattle marketed at those higher price levels.
Well, and you mentioned hogs staying strong, and just briefly on this hog market, we're starting to see that spread between those front month contracts and those deferreds. I mean, just the last couple of weeks, we've really seen this hog market pull back, and now we kind of leveled off. But what is your thought on this hog market? Can we maintain the strength moving forward?
Not without China. I think I'm going to stay on that track. And, the domestic cutouts are going to remain very firm because they're competitive with beef and chicken right now because of the prices at the meat counter and at the restaurants. You're still going to see a lot more pork tenderloin served versus Kansas City strips. And that's one of the things, one of the restaurants in Kansas City, the owner chef said, I can't ask clients and customers to sell a $50 Kansas City strip. So they're going to replace that with something else. So I think the domestic market's very solid for the pork. So that means the cutout should be very solid. It's the export market that we really got to keep watching for the pork side. And I think more traders and more funds are starting to believe that China is going to buy less as we get into the fourth quarter.
Well, Mike, any other thoughts you have for us here on today's show as we kind of wrap it up? I know sometimes we look at the outside markets and energies and lumber and all sorts of things like that. Anything on the outside markets that you want to mention here today?
Because we don't have a lot of time, and I really appreciate the time you give me, Jesse, but I did a special report on the global economy and the global commodity markets over the next 6 to 12 months. And of the three big factors I looked at, I was really surprised that the analysis led me to China being the biggest feature to what could disrupt the global economy quickest and what could disrupt the global commodity market quickest, as opposed to inflation and Federal Reserve policy or even COVID. They're all three interlinked, and I did a special report on that. I think that people would really enjoy reading and give an idea of where we're headed maybe in the next 2 quarters.
Well, and I know folks can get that special report and all your great analysis by going to your website, globalcomresearch.com. Com has 2 M's in it, and I know you got a free trial folks could sign up for, and a lot of great things and a lot of great advice that people can look into with you at Global Commodity Analytics, can't they?
Yes, they can, including this video. I throw it out to all the clients and subscribers after you post it, and they really enjoy what they're listening to, and they enjoy your commentary and your questions, and you're just doing a great job, sir.
Well, I appreciate the time. You make it easy, Mike. And again, you can find out more on his website, globalcomresearch.com. Mike Zuzolo, appreciate the time on this Wednesday. We'll talk to you next week, sir.
Take care, Jesse.
Mike Zuzolo joining us today with Global Commodity Analytics. That's going to do it for Market Talk on this Wednesday, July 7th, brought to you by GrowMark FS. I'm your host, Jesse Allen, wishing you a great rest of your day.